Testing high volume bars on the ES Mini using a 5-minute time frame. This is a lovely little study. I remember this day very clearly. There are four no demand bars. If we take a look here, perhaps these no demands are not that apparent. However, we can always add structure and further bar analysis. So what do we notice? First of all, we have been in a trading range where we have built cores. So this would be our length of line. We must always take into consideration where we have been. What has price done beforehand? Clearly we can see that we're making lower prices here, but we don't know that while we're here. So when we break, we need to bear the cause in our mind's eye. Very good to form. Anyhow, we break at 1. What do we note? High volume, widespread, closing weak. Over 50% of the spread closing under our structure area. Therefore, this gives the break validity. Beautiful, perfect break. 2 bars later, we have an up bar here, lower volume just than the previous 2 bars. So bar A technically is a no demand bar. Okay. However, we would want a smaller spread, perhaps like so. But as we know, nothing is perfect in trading. If we don't take bar A as a trade, which is very difficult, there's always this bar here. Why? Well, because this would be a rally back to ice. We break, which is valid, and then we move to test on what? Much lower volume than our original break. So that is a valid setup. Okay? But we're not talking about rally to ice. Let's carry on with our no demand. So A is a demand, but pretty much untradeable. We have this little logo here. Boom, what happens? Look how we come down. Wonderful volume. We break this level of support. Boom, with another spike in volume. Much of the spread, most of the spread, 80-90% of the spread closes under our area of structure, our local level of support, with an increase in volume, closing weak. Another valid move to the downside. Then what happens? 2 bars later, B prints a textbook 10 out of 10 no demand bar. Why? Very narrow spread with no volume. There is no buying ability here. This bar we can trade. Volume has dramatically reduced and the spread has narrowed. We are getting continuation to the downside. Look at this. Good flow, good spread, good flow with volume. And we're coming down like this. This is beautiful trending action. So we can buy B on the close very, very comfortably. Okay, that is the perfect no demand bar. And where are we? In an area of supply. We are testing for demand in this high volume down bar, which is a supply bar, which fails. Boom. And then we fall. So from here, we drive down to 3. Volume increases, another wide spread, closing weak. 2 bars later at C, boom. Another no demand, narrow spread, low volume. There is no demand in this market. And where are we? In this area of supply, the big widespread down bar. We can trade both of these no demands on the close at B and C. Think logically about this action. Supply is proving itself at 1, 2, 3, and here, and here. We're getting good flow, good ease of movement. Then sellers ease off the gas. Okay, they stop the selling here, they stop the selling here. Then they let the buyers try and come into the market, and there's no volume. There is no volume. Okay, So bars B and C are an attempt to rally, where we see buying of poor quality after we see selling of good quality. So there is literally no buying force, illustrated by the volume and the spreads. Ergo, we can short on the closes. Textbook. Okay? Beautiful, beautiful no demands. And then from 4, we dip down a bit. We see some volume come in. Okay, we expect a rally. Unsurprising. Why? Well, because we've been trending down all day. Perhaps there might be some profit taking down here for whatever reason, that some volume comes in, but importantly, nothing overt, nothing climactic. There is no ultra high volume here. There's no wide spreads signifying there might be a turn in trend. You know, there might be some kind of reversal action. We don't see that here. Nothing too overt. Okay, so from here we do rally up, then we come to D, which for me is the best trade on the chart. Why? Well, it's an up bar, low volume compared to the previous two, but we are at structure. We have a no demand bar in an established downtrend, okay, at a supply confluence. We have resistance here and resistance from our supply line that has held all day. So ergo, no demand. Yes, this does have higher volume than these two previous no demand bars. However, we must take in consideration context. This is still lower than the previous two bars. Okay, and we are in an area of supply at a supply confluence. So we have structure to lean against. This is a wonderful trade. And if we do take this trade, if we take this trade alone from D, what is this? That's 9 points. Beautiful. 9 times 4, that's 36 ticks. Very nice trade for half an hour's work. Although I am saying that D is the best trade on the chart, as we do have structure to lean against, and it is, okay, but B is a wonderful, it's a very, very close second. We can clearly see there is no buying ability at B after we see this selling. And don't forget, what else does B have on its side? Yes, we have selling in the background, and we've just broken structure with no demand, good selling, no demand. But B is where we must take into consideration that we have cause. And now B, over here, after we've disconfirmed demand, buying after selling, we want to hold on to the trade because of this cause that has been built. You know, the market has a lot more to offer to the downside. We don't know that any of this occurs after B at this time, but we take this into consideration. So B has a lot going for it. However, D is the safest trade on the chart due to two areas of structure, a supply confluence. Perhaps not as clean in terms of the no demand, but technically is a no demand bar, and we do come from a little bit of strength here. Okay, however, structure holds. This chart highlights the no demand testing bars into high volume bars. No demand, high volume. No demand, high volume. No demand, high volume. No demand, high volume. Okay, four examples in one trading session. When one becomes competent in their chart reading ability and has the confidence to pull the trigger, trades B here, these trades here, B and C, they become automatic. They become, no-brainers. Please don't take this as arrogance. It's far from arrogance. It's just the ability to read the demand-supply imbalance here, as in there's no demand in the market after we've seen sellers prove themselves. Okay? And we have the confidence to pull the trigger. Don't get tickitis. When we see B and C, don't wait for the perfect entry. Just hit market. Get in. Because this is telling us there's no demand in the market. And we want to get involved. Do not get, analysis paralysis or tickitis. Don't wait for the perfect entry. The market has a lot to give, as we know, from the cause built from our trading range above. Of course, taking trades B and C automatically does require time and practice. I'm not saying it's going to be easy. However, spend time, understand this behavior. No demand bars in high volume supply bars at resistance, like here, a supply confluence, are very, very powerful trade setups. We're leaning against structure. This is very favorable conditions, but we need to up our skill level to trade B and C. Why? Because we don't have structure to lean against. And as I've just previously stated, when B and C print, hit market straight away. Why? Because we can read the imbalance. The market in fast liquidating moves does not always test structure. We may not, well, we don't here. We can see that we do not have a chance to test resistance, and we want to get involved. So don't get tickitis. Get involved when you can read the markets, or should I say when you get a clean read, like we do at B and C. This concludes our session on testing. On to the next subsection.